February 2006 marks the day for Taiwan's credit crisis. Taiwan's credit crisis first problem began in the 1990s when financial institutions were artificially inflating housing prices to provide easier access of loans to subprime borrowers. Banks loaned enormous amounts of money to real estate companies with the goal of expanding profits. After many years of expansion, the real estate market became saturated and profits for major banks from the financial sector stopped growing. Questionable credit practices on behalf of both buyers and sellers ignited Taiwan's credit crisis starting in the early 2000s by even targeting students without proof of jobs. With the abundance of cheap credit spread to the masses, banks prioritized short-term deal flow over long-term value creation for the credit industry on the theory that housing prices would continue to increase and people would pay off their loans. The financial system was not designed around for credit users defaulting. Major banks in Taiwan lacked adequate capital holdings to back the financial commitments they were making and ultimately failed, triggering economic depression. The 2006 credit crisis was far beyond the confines of bad credit users, but a more systemic problem of the financial system in Taiwan. The economy rebounded, thankfully, but at the cost of total economic collapse and hundreds of thousands of people living in the streets. With the housing market in full swing, banks looked to somewhere else to make more money. Their eyes turned to the credit card industry. Banks encouraged thousands of people to apply for credit cards. They did this by lowering interest rates and lowering the requirements for credit card approvals in order to get more customers. Hundreds of thousands of people were getting approved for credit cards every year. By lowering the requirements to receive a credit card, a student who has no proof of a job or income can get a credit limit of over $15,000 a month. This is the start of the debt bubble. The image shows the average credit limit of a credit user in the thousands. Between 2005 and 2006, the average credit limit rose from $15,000 a month to just over $25,000 a month. Banks were making millions of dollars off the interest and activation of credit cards. However, in February 2006, the entire financial system collapsed. The accumulated debt from credit cards reached over $268 billion at the time of the collapse. More than 500,000 people could not repay their loans. The people of Taiwan could not repay the minimum balance of the credit card debt that was due every month. These people were soon to be called credit card slaves. Societal problems soon followed the crisis. Suicide rates were at an all-time high in 2006 due to how much debt families were in. People could not pay off their mortgage and soon took to the streets. Families could not afford to pay for their children's tuition or daycare. Children and students stopped showing up to school. People turned to selling drugs on the street to repay the banks. The debt bubble has burst. The Taiwanese government was forced to save the financial system in order to prevent further societal problems. Panics are often driven from crisis. During a panic, the government has to use overwhelming force because you have to convince people it's safe and not to run, and not to panic. And in order to do that, the government has to accumulate huge amounts of money and new regulations in order to restore faith back into the financial system. On March 10, 2006, the Bankers Association reached an agreement to create a public asset management corporation to deal with credit card debt and to help low-income people to solve their debt. Banks injected bad debts that existed before 2005 that were more than 180 days overdue into the new public asset management corporation. In July 2006, the Taiwanese government passed the Debtors Repayment Regulation. The main purpose of this new regulation was to help people who did not have money that could not repay their debts to start clear and start over. These new regulations also applied to credit card applications. Credit card applicants had to show proof of income and a job. This was in hopes to eliminate banks from targeting young students. With new regulations and a clean slate for credit users, the financial system in Taiwan has been reset. Banks are now responsible for monitoring risk and how much risk they can accumulate. There have been many studies in which researchers and banks attempted to classify credible or not credible clients if they will default. This is a binary classification and has a higher probability of misclassifying a potential credit user. When there's a misclassification, banks are losing potential money from that client. Conversely, banks can lose money if the credit user ends up defaulting. Therefore, the accuracy of analyzing a client's probability of default is imperative. The purpose of this study is to determine the probability of a credit user defaulting. The work of this study will advance the risk management sector of banks by associating probability of default with the current potential clients.
We found a data set that includes 30,000 observations of unique cardholders. Of these cardholders, 6,600 of them defaulted on their credit card debt. However, the original authors of the dataset included variable values that were not defined. Due to this, we removed those observations from the dataset. Therefore, we were left with over 23,000 observations, with 5,300 of them defaulting on their credit card debt. The dataset is made up of 23 predictor variables that fall into two general categories: the demographic information and the financial information of the cardholders. This first figure shows three of the demographic variables. The orange shows the distribution of the cardholders that did default on their credit card debt, while the blue shows the people who did not default. The top graph shows the sex of the cardholders, split into male and female. As can be seen, the majority of cardholders were female. Females also had a higher rate of not defaulting on their debt, while males showed higher rates of defaulting. The second row shows the highest level of education achieved by the cardholders. Here we can see that the majority of cardholders were university graduates. Those that obtained a graduate degree had a larger percentage of those that did not default, while those that only had an undergraduate or a high school education had a higher percentage that did default. Our reasoning is that the cardholders with higher education were more likely to earn more and pay off their debt more easily. The bottom row shows the marital status of cardholders. The majority of cardholders were single, who also had a higher percentage that did not default, while those that were married had a higher percentage that did default. Our reasoning is that the married cardholders had two or more people to support, such as children or aging relatives, and therefore needed to spend more money to do so. This next figure shows the age of cardholders. The majority of cardholders fall between the ages of 25 and 40. Within this age bracket, cardholders had a higher rate of not defaulting, while those outside of this bracket were more likely to default. For the cardholders younger than 25, we believe that they had higher default rates because they were less likely to be employed or had jobs that paid well enough to pay off their credit card debt on top of their student loans. For the cardholders above 40, we believe that they had higher default rates because they had to spend more towards supporting family members such as children or elderly relatives. As we move on to the financial information, we first take a look at the credit limit of cardholders as expressed in New Taiwan dollars, which I will refer to as dollars throughout the rest of this presentation. The majority of cardholders can be found in the $0 to $125,000 range. Within this range, we see higher rates of defaulting, while outside we see higher rates of not defaulting. We believe this is because those that could not afford to pay off their debt were less likely to receive larger credit limits, while those that could afford to pay could get those larger limits. The next series of graphs show the payment status of the cardholders throughout the months that were studied. The values of the payment status goes like this. A -1 represents the cardholder paying within 1 month prior to the due date. A 0 represents a payment on the due date. A 1 represents a payment delay of at least 1 month. A 2 represents a payment delay of at least 2 months, and so on up to a value of 8 or a delay of 8 months. The majority of cardholders paid either early or on the due date. In general, we see that those who paid early or on time had a higher percentage rate of not defaulting, while those that delayed had a higher rate of defaulting. As time progresses throughout the months, we can say that those who paid on time were increasingly more likely to not default, while those who had payment delays of at least 2 months had a growing rate of defaulting. This is because the longer cardholders delay the payment, the more debt accumulated and therefore the likelihood of defaulting grew. The next set of graphs show the amount cardholders were billed for the months that were studied, as expressed in dollars. From here, we can see that the majority of cardholders were billed below $50,000 and had higher rates of defaulting. As the bill amount increased, we can see that there were slightly higher rates of not defaulting. We believe this is because most people do not get accepted for higher credit card limits and thus cannot be billed as high. Those with higher credit limits generally have higher accountability for paying back their debt. The final set of graphs show the amount cardholders paid towards their debt for the months that were studied, as expressed in dollars. From here, we can see that the majority of cardholders paid below $5,000 and had higher rates of defaulting. As the payment amount increased, we can see that there were higher rates of not defaulting. We believe this is because if someone cannot pay off their debt in that billed month, the cardholder will be more likely to pay the minimum amount required for that month. As time progresses, this minimum amount increases and people start to default. Conversely, the cardholders whose payments were higher towards their debt receive less interest on their debt, making them more likely to afford their payments and less likely to default.
There are many ways to implement machine learning algorithms to credit analysis. However, this study will focus on two main methods. The first method is naive Bayes learning. The second method is logistic regression. A high accuracy and precision of the models are imperative for this application. We expect that the naive Bayes learning will have high accuracy, but potential not enough high precision for this application. K-fold cross-validation will be used in order to ensure that the best model for naive Bayes can be found. 70% of the dataset will be used for training and the other for testing. After training, further analysis will be needed on which naive Bayes model will be used for testing. We expect that the logistic regression model will have high accuracy and precision as well. This is due to the fact that we can set the probability of certainty higher, for example, 0.85. The logistic regression model will provide banks more control over how much accumulated risk they want by setting the sigmoid function to different values. The lower this function is, the more risk banks will take on credit holders. A neural network can also be used to implement for credit risk analysis. However, due to time constraints, the neural network might not be developed. Other researchers have shown that the neural network had the best results between all other models they tested.